Okay, Hit It Monkey, I guess in the update part one. I wanted to use this time. I had some extra time today, so I wanted to put on a bunch of videos as much as I could to help new people out. I wanted to go into kind of in practice what you could do based on that monitoring and placing a golden gecko trade. So, what I'm going to do is I'm going to go to this golden gecko trade right here, and I'm going to go to my favorite slides and have these up and ready. So first thing I'm going to do is let's say you go to your computer, you open up your charts, here's your thinkorswim charts, and you go, okay, well, here's the SPY. I changed the background a little bit just to see if that might help with the visuals or not. Let me know if this is bad or worse. All right, so you can see, wow, well, look, what's going on? Markets up almost over half a percent. We have IV rank of 40, so it's not quite 50. You can tell that by right here, or you can, of course, you can look over here. Your IV rank right here is 40.334, and we've got on balance volume is on the rise, up, not quite hitting its average, and your slow stochastic cross 50 is green and heading up. So anyway, a lot of things could happen here. As you can see back in February, see how large this divergence was here between the average and here, and it caught up. And when it was at its lowest right here, see these were kind of in sync. As you can see, it went green here at 50, and it's pretty much touching here. The difference between now and then is look at the average here. It went green here, and this was still all the way down here, and it hasn't even touched yet. So people are worried that it might be, the market will correct quickly again, because we just had this large correction, as you can see, from here to here. So what could happen is this could theoretically bounce off this average and go further, because this, you know what I mean, like this tops up, goes red, and hits the overbought area right here. This turns on and bounces off, and this goes lower. Okay, that's one scenario. The other scenario, if this turns green and then this stays up high like this, okay, so this goes green. See, look, when this went green, oh well, it was already up here. But if this goes green here and this is already up here, this could run even higher and break our highs. That could threaten some of my call. I think I have a call trading at 190 something. Let me look real quick. I do have a position here in the SPYs trading around there. But that doesn't expire till November. So that doesn't expire till November expiration. So I got a lot of time. Even if it does climb as high, I got time for it to come back down. And like I said, I kind of wanted to pin like around that 190 area, 189 area, right around. Actually, it's down here. Okay. Let's take a look at one real quick thing. I'll add on that ADX just to see average directional cross index. Where is it? Add a study. Go to all studies. Go to A. Click on ADX right there, and it'll pop up on the bottom. See, so well, what I'm looking at too is just like how it topped up around 32.33. I'm looking at to bottom. On average, this thing has been really low though, down here to the 8.6. Most recently, it bottomed out at right around here, around the 15 area. That's where it topped out. So if this thing gets around to this 15 area, look for the market to kind of turn downwards again. We got a ways to go though. All right, before the market turns over, according to the charts. Now, so what do? Oh, Mark, I kind of want to trade the SPY, and you're thinking about Mark, IV rank is 40, it's above 35. How should I trade this? Okay, well, let's go to those favorite slides again. As you can see here, selective entry ETF, when IV rank was above 50, right, it had 93% winners collecting 19.8% of the expected move. Well, IV rank is not above 50, but they did say when IV rank, they did say when IV rank was above 35 and you collected 19.8%, you had an 84% win rate over here. All right. Okay. Now, and these are at one standard deviation triangle. So, okay, so we can trade this. We want to look at like 19.8%. Another thing you want to look at is right here, volatility adjusted strikes. Okay, so when the SPY is between 25 and 49, you want to trade optimally a 1.5 standard deviation strangle, which is a 91% out of money strangle. Okay, so what you want to do is look for 91%. So let's see what that looks like. You're gonna go to Dole. You're gonna go to your trade page. You can type in SPY, like I already have SPY up here. Okay, I have a bunch of positions on, so that's messy. So why don't I go ahead and hide that for you guys, just so it's a lot cleaner. Okay, so I'm hiding my working and my positions, and it's nice and clean. So as you can, I'm gonna zoom in. So as you can see, currently in SPY, these blue vertical lines are the 1 standard deviation lines. We usually sell down here. We sell a put here and a call here, betting that the stock will stay in this range. And then we go ahead and buy the wings. See this blue line right here? It looks like a bird, right? This is the body or the head of the bird right here, the body, and the wings come out to here. We usually go up here and we buy the wings. We buy a call wing here, and a call position here, and we buy a put here. That gives us defined risk and also frees up, doesn't tap as much capital. So what you could do is, I'll walk you through the steps real quick. I'm going to go to strategies. I'm going to go to strangle first to see how much we can collect. Okay, these are my default positions. You can change this to 56 or 40. 56 is what Canada Super Trader does. But what she does is she trades that she churns it. She puts positions on, and as soon as she makes a little bit of profit, if she can make 10-15% of her max profit, right away she'll take it, and she'll do that all the way till about 40 days expiration, and she holds them. But I'm going to keep it for now because we can always adjust it. Okay, so let's look at what we can collect. See, look, we have 56 days expiration. It's a perfect time. It looks like we can collect $1.89. Is that enough? Is that 19.8% of the expected move? To find that out, we need to go and look what the expected move is. Open up your Thinkorswim. You have SPY here. Click on your trade page right here, and then you're gonna have what's called your option chain. Look for the same amount of days to expiration. We're looking for 56. Here we go. December, 56 days expiration, and 100. These are the standard options. If you see 100, those are your standard options. Why? Because one contract equals 100 shares of stock. Okay, expand this out, and then move your mouse over here and look. The expected move up or down by 56 days expiration is $11.18. Open up your calculator, okay, and type in $11.18, and you want to multiply that by 0.198. So you want to get $11 and what the heck did I just say? Sorry, I got ADD. $11.18. $11.18, multiply that by 0.198, and that'll give you $2.21. So to collect 19.8% of the expected move of $11.18, we need to collect $2.21 in a strangle. As you can see here, we're not collecting enough, right? But that's okay. It's within the area. You can still do it. So let's increase our odds a little bit. We now know we want to collect around a 91% or 1.5 standard deviation strangle. Why? Because our IV rank is between here and here, right? So a 1.5 standard deviation strangle is it's in between 1 and 2, which is around 91% out of the money. Okay, so let's go back to Dole, and let me just show you what that looks like. See these are the dollar amounts. It's as where the put is, $183 put on a $211 call. And what this basically means is anything in the green area, as long as the SPY stays within these strikes or these dollar amounts, currently it's at 196. Okay, we make money. Well, let's put on our golden gecko 5 strikes wide, because that's our default setting right here. Okay, and you'll see the same strike prices, right? The difference now is we're going to click on this leg icon here and see where it says 83 and 85. We're going to widen these out until they get close to about 91% out of the money. So you probably want to get close to 91%. So let's expand these out like this, and then we can adjust it on either side. Okay, so here we're at 91%. This is basically this right here. Okay? So that's the adjusted strategy, which usually gives us our highest rate of return, which is, if we look over here, when they did it, I'll open it real quick. The adjusted one had a nice win percentage. So let's go back to Dole. And now we can leave our strikes 5 wides apart. It's still five. What do I mean by $5 wide? If I click on leg again right here, see this is $178. Well, 178 minus 5 is 173. Okay, 216 plus 5 is 225. We're 5 strikes away. Okay, now if you notice, when I click on this leg button, look what happens. Okay, it shows you the percentage, and it also shows you how wide the strikes are. See this 38? It's 38 strikes wide from here to here. It's 5 strikes wide from here to here. See? And it's 9 strikes wide. See? So I could actually move this in. See? Perfect. I can move this in so that it says 5. And see what happens? It's not quite. There's nothing in between. So we'll leave it there for now. Okay? And we have an 83% chance of making money. And we're only tying up $858 of capital. 10% of that is $85, so we're gonna make just like a 5% return on your risk. Okay, why such a low return? Well, because we have such a high probability of such a high probability of success. It's the weekend, so you know where my mind is at. Anyways, all right, so that's what, and you're collecting 42 cents. Now, with this type of trade, you know, you're going to want to hold this to expiration. Why? Because at 42 cents credit, the max you can make is $42. But to get in and out of this trade is going to cost you $12. So the max you're going to make is $30 on this trade per contract. You can do more than one contract. I'm just saying, you know, because IB rank is not high, you're not going to be able to collect as much. All right. The reason why they do it on the SPX is look at the same trade on the SPX. If you trade the SPX, okay, and I'm going to do the same trade, I'm going to go to 91% out of the money. This is kind of like a Karen trade for real. This is why it works so well if you have a margin account and you have a lot of capital to play with. I'm going to go to strategies. I'm going to go to the same iron condor, right? And I'm going to widen this out until you see 91. Okay, one more. See, we can collect way more money now. Okay, we can collect more money now, but we're gonna, because it's so expensive. This thing trades at 1986. Look at our risk. We're risking 952 to do 48. Now, what Karen does though is she's really doing naked strangles. So watch this. I'm gonna go to this, go to strangle, and I'll just show you exactly what hers would look like at 91. And then widen this so it says 91. Okay, that's 91 here. Let's move this one out to 91. No, not quite. Oh, right there. Okay. Look, she has an 85% chance of making money, but she's collecting $12.13 per contract. That's 1,213 cents per contract, and her average trade size is about 500 contracts. Okay. Well, look at how much capital she has. Look, this ties up a bunch of capital, but this is, you know, buying power is a lot. You know, you're tying up about $5,000 of buying power. Multiply that by 500. That's how much capital she's using. All right. But for her, it's okay because she's on margin, and she has a lot of capital to work with. So that's what so basically, on a smaller scale, that's what you could do. So I've got a couple minutes left, so I'll walk you through it again real quick. Because we know that IB rank is 41%, we go to our chart and we see that when IB rank is 41%, what do? You want to trade at least 1.5 standard deviations out the money, okay? And we also know that well, these other ones are management time frames here. So you could print these out, like I said earlier. And we want to collect 19.8%, but we already discovered that we can't really collect that. So we're going to improve our odds by going wider out to 1.5 standard deviations. Oh, wrong button, crap. I'm going to go to the next page real quick because today's market measure, do I have time? 30 seconds. That's just amount of cap. Anyway, so yeah, that's all you got to do. I'll go over that in another video in part 2. So anyway, real quick, I've got 20 seconds. That's what you do. You go to Iron Condor. You want to go to the 1 standard deviation, 91% out of the money. Just move these suckers out to 91%. And you can go ahead and place your trade. keep it at 5 strikes wide or go out to 2 standard deviations. Hope that helps.